All right, it is September 11th, just afternoon on 2020. And I wanted to take a moment here early on as we're doing these market talks and, and get an opportunity to tell you a little bit about our portfolio construction and how we think about portfolios and how other people think about portfolios and what you can look for. So one
Mhm.
of the phrases I often repeat is that it's pretty simple to get average when it comes to building a portfolio and get in the market. So you know, anyone can go out and buy the retirement 2045 fund or 2050 or whatever aligns with the year that you retire and invest in that and get what I would consider an average return, an okay return, something that's it's better than nothing. You're investing and you're not going to blow yourself up with that, at least in the short term. But it isn't really a very thoughtful approach.
Mhm.
It's a baseline approach, and there are a variety of different kinds of baseline approaches. And I think it, everyone has an appeal to having some kind of solution where you can just fire it and forget it. You can set it and sleep at night and never even have to
Mhm.
think about it. What kind of portfolio can you build where you don't ever have to touch it? All you have to do is rebalance it once a year and you can sleep like a baby. It's going to work out. You don't even have to worry. And there are portfolios that were designed to do that. There are different theories toward portfolio design to be able to accomplish that end. And so what I wanted to do today was talk about what we do and compare it to other kinds of portfolios, other strategies for portfolio development. A very,
Right.
very common one is the 60-40 portfolio, which means it's 60% stock and 40% bonds, usually Lehman aggregate, so relatively short duration bond index that encompasses um, uh, corporate bonds as well as treasury bonds. Um, and then the 60% stock portion can be all kinds of stock. It can be international, domestic, whatever. You pick your categories for what structure you've put in as your stocks.
Mhm.
And that's been the traditional go-to portfolio for forever is 60-40, 40% bonds, 60% stocks, and fire and forget. That's going to be a good portfolio. It's going to work out. You're going to have better drawdown metrics. You're going to have better risk return profile than if you just invest 100% in stocks. Well,
Mhm.
they shouldn't say that, right? Because nobody ever thinks that somebody would actually be so bold as to invest 100% in stocks. So you have to choose your line somewhere. And a lot of people choose that line at the 60-40. So 60-40 is very common. A lot of traditional, if I want to say what's the traditional portfolio management approach, it's along the lines of the 60-40 portfolio, some portion of stocks or equities, some portion of bonds, and we're going to put them together and we're going to see if we can get a balanced, diversified portfolio that gives us a good return. That is, well, we'll take a look at that. Another portfolio design, as I mentioned before, some people will call it an all-weather portfolio or the permanent portfolio. That one involves some combination of gold, of domestic equities, of international equities, of bonds of various stripes and kinds. And you can really tweak with that. You can back test it to death to try to figure out which one performed the best in 2008 or which one performed the best in 2020. But if we take a really long view of that, there's been a portfolio for a very long time called the permanent portfolio that you can use to compare. Okay, that's a strategy where you really can create something to get it to work.
Mhm.
So those are two very common approaches, and then we have a third approach, and our approach is one where we say, we don't necessarily have to limit ourselves to having only the 60-40 or the permanent portfolio. What
Mhm.
if we can build a portfolio that has a position where we are 50% stocks and 50% bonds effectively, but we only takes half of our portfolio to achieve that
Mhm.
exposure, right? And so inherently in that is the idea of leverage. And I know leverage gets a lot of people, they say, "Oh, leverage, that's a risk." I know that's a risk. I've been trained after my
Mhm.
years of doing this that leverage is a risk. But what we're talking about is limiting the amount of dollars we have to use to expose to something to be able to get the return profile we're looking for. So we're not talking about using leverage to get overexposure, at least not in this instance. We're talking about building what we call a core satellite approach. A core position, that's the bulk position that gives us the exposure of a 60-40 kind of portfolio, but a little bit better, we
Mhm.
think, with the satellite pieces that go with it, right? And
Right.
we've talked about the satellite pieces, and just for catch up, if you're listening to this one, where we talk about having momentum, growth, large cap, those are the main drivers that are giving us excess performance these days, because 2020s will be defined, has been defined by growth, large companies, and momentum. And we think that's going to continue. We can't just all do that, because then it's just a wholly aggressive portfolio that might be appropriate for some people, but we also have some other pieces that help give us some more protection, things like oil and gas, or some short exposure, and things like brick and mortar retail, right? That's just full disclosure. That's our portfolio, right? Is that core satellite approach.
That's right.
So the core, when we look at it, what do we make that core exist of? How can we invest half the money in our portfolio to get us the return of essentially a 60-40 portfolio with just that portion, and then allows us all these other pieces to be invested alongside. So to look at that, we've created a tool that we use. We use Y-charts, and go ahead, Daniel, if you could pull that up for us. We'll take a look and walk through what the core piece of the portfolio looks like in comparison to the portfolios that we've just talked about.
Yeah. Here we go. Tell me if you can see that, okay?
I can see it fine. Looks good. Thank you. So what we have here, and I'm gonna talk about it. Daniel, just move the cursor around here, and I obviously in each format it's gonna be different, right? We're gonna have more conversational. This time I just kind of want to talk through these different portfolios and look at it. So again, today, September 11th, we're looking at basically September 10th data on these particular portfolios, and we're looking them back. So each of these portfolios are actual positions. These are not made up numbers. But we're using them to be characteristic of them. So we're not showing the actual individual position. We're showing what the portfolio philosophy looks like. So the core position here over the past 3 months is purple, and we can see over this time period that it is right there between what the all-weather portfolio would return, as well as what the 60-40 portfolio would return on a 3-month basis. And it's, yes, are we cherry picking a little bit by picking our end date? And are we also doing some back testing because we get to choose what the last 10 years looks like? To a certain degree we are, but this is real data. And we can take the data and you can run all your tests with it. You can determine your drawdowns. That is, how much does it lose in a bad environment compared to something else? And we'll see that as we look at, how did it perform in March of 2020? We can get into some more of the details, but the important part here is that, we think that the portfolio construction that we have is superior to these other styles of portfolio construction. And this is how we think about portfolios. How can we do it differently? How can we, not to do it differently for the sake of doing it differently, but how can we do it the best that we can? And this sort of strategy gives us a better outcome.
Yeah.
So go ahead and take a look at the 6 month here. And it's also showing us the recovery portion effectively, right? We have a little bit of March where we bottomed, and can you hold the cursor over where we bottomed there in March?
March 10th there's where it's starting us.
And where did it bottom?
Bottomed on the 18th and the 23rd.
Yeah, so at the bottom, we can see that the core position that we have, because of the way that it's structured, actually returned a little bit less than the other markets for a very short period of time before we were able to kind of recover and pull out of it. And for most of the recovery there, including this initial drawdown, we're actually a little bit behind the benchmarks for that 50%, that core piece of the portfolio.
But when you include the year-to-date?
When you include year-to-date, it's a different picture because we had good performance in the first couple months of the year. And notice how well it held up in the first week. Pull over there to that. There you go, to that March 8th. The market had decidedly started to turn down at this point. We were starting to get into those days where the S&P and the NASDAQ were down 6 or 7%, and impressively, all of these portfolios are holding up well. If we could put in the S&P here, you would see it dropping off like a rock. And the difference is that all of these portfolios have bonds in them, and bonds really did hold up well. And particularly the core position that we uses long dated treasuries as the defensive position part of it. So it held up particularly well until the bonds decided to go along with the stocks. So the bonds decided to crash as well after holding up well, and that's the drop that we have from that March 8th period. I think it was it March 8th where we're kind of at the peak there? There it is. Yeah, exactly. The 8th. down to basically the 19th.
First to
And
12th, and then, yep, there it is right
yeah.
there.
Now it doesn't look as bad here. Actually, the 60/40 and the all-weather portfolio actually underperformed this portfolio on the year-to-date basis, but we don't have a tendency to do that in real life, right? We don't always think of of January 1st as the arbitrary start point. We remember what was our portfolio there at the end of February, right? We compare it to that, and if you compare it to that, the drawdown that we have is actually a little bit bigger than the drawdown there, even though we don't go down as far on an actual year-to-date basis. The drop is still pretty substantial in that range. But like the other portfolios, bonds did recover pretty quickly, faster than the stocks did actually, and that's why we have that big boost coming out of it from the 23rd right out by the 30th, right back to being higher. And I thank you. That's a good spot right there. By April the 29th, we were back to being positive on the core position. Now, again, in ideal,
took a little while longer for the other positions to get to zero. I mean,
that's right.
See them. It's like right here.
Yeah, about a month later, the other portfolios did catch up to being positive on the year again. Again, as we saw in the 6 month, it's not because we outperformed, but because we had a better starting position by having performed better into the first part of the year. But where was I going with that a second ago?
I'm not sure, but do you want to talk about, so this core position on this example is 50% cash and 50% the core position. So this isn't even 100% position. I mean, in 100% of our core position,
right?
You'd see even different performance there.
Yeah, and just to get on that, because we do a core satellite approach, what we're representing is the core by itself. If we didn't have the satellites, we just limited the satellites and went to a more conservative kind of picture. What would our more conservative picture look like? Well, it would be very consistent with the 60/40. So if we can provide any kind of outperformance at all on any of those satellite positions, then we are going to outperform what this looks like. Now, the converse of that is true. If we underperform on any of those satellite positions, we're going to do worse than what this picture looks like. But the core position is the core position. It does drive the performance of the account. And so that's why it makes sense to look at this, and why it makes sense to look at this with it 50% cash and 50% vested, because that's how we do it in the portfolio. And if we can do this if we can show you that only 50% of it being invested does this, then you can see the opportunity that we have to do better than a 60/40 portfolio than we can to do better than even S&P 500 over this particular time frame.
Yeah.
And so that's really the goal there, is to have a core position that gives us a really solid return without taking up all of our capital. That's why it makes sense to do a little bit of a leverage position on that, to have some leveraged exposure, so that then we can add those satellite positions to give us the better pool. Whereas the 60/40 and the all-weather portfolio is 100% of somebody else's portfolio. They have to be 100% invested to get this outcome that we're seeing here. We don't have to do that for ours. We could do 50% to get this outcome, and then it gives us 50% more to be able to do something else with. There is a cost associated with that, and we see that a little bit in this instance on the drawdown. But there are very few times where the drawdowns that we experience with this kind of portfolio are extensive. Usually what happens is we'll have a drawdown that's relatively large, but it quickly snaps back. And it snaps back because we have two drivers of performance in this core portfolio. It's not just that we have S&P 500, it's that we have S&P 500 and long-dated treasuries. And long-dated treasuries have increased in price over time as interest rates have declined. So when you look at that 60/40 position, we're able to effectively match that, but only invest half the funds. And that's a really wonderful outcome to have. Go ahead and show what the 10-year or the 5-year look like. Yeah, just work your way back there. And we can see that over the past couple of years, we're having very similar performance with that core piece as the whole portfolio. This is a very nice cherry picked time here of 3 years randomly where our core position 50%, again, only 50% invested, is actually outperforming 100% invested in a 60/40 portfolio. That's not what you're going to see all the time. So we'll keep going through the years and see what they look like. On a 5-year, again, it looks like it's doing great. And then click on the 10-year there, and we see more of what we expect it to look like. Now, even here, go back down there and show with the cursor 2012
Right.
all the way through 2014. Look at how stable the performance is on an upward basis. A lot of portfolio managers desire that with their investments. I'd rather have the blue for that portion than the purple, because give me all the volatility you want to give me if it means I'm going to have better returns. If I know it's going to give me better returns, I don't care about the volatility. I want the better returns for most people most of the time. But it is a great outcome to have that very kind of nice flat growth that we get in the purple there at the beginning. And obviously the permanent portfolio, the all-weather portfolio, which is the orangey color, starts off doing pretty well, but really suffers in 2016 and 2018. There at the end of 2018, there are a couple of bumps there where permanent portfolio just can't seem to get its engine going. And that's because the permanent portfolio, the all-weather portfolio, I'm sorry, using those interchangeably here, they're designed to work in all markets. And inevitably, when you have something that doesn't really have a core, doesn't really have an engine, there's going to be times where it just sits and doesn't do much. And there's always going to be some positive performance, but the trade-off is you're going to be below the performance you would get from just the S&P 500 or from anything else. And at times like this, where we've had 10 years of really good markets, it's going to lag. But in times where 2008 happens, the all-weather portfolio is going to look like it's the best for a short term period because of the way it's constructed. So it's a little bit of a not perfect analogy here to show that, because we're in this really great market, but the all-weather portfolio does well in negative markets the best. But you can see how much does it suffer over a 10-year period compared to even a 60/40 portfolio. Well, it's half as good, less than half as good, and that's really painful. And that's, when we design portfolios, we want to be able to capture more of the upside when things are going well by having that core position and some satellites around it, and be a little tactical with those satellites to be able to say, okay, where are we in the market? Are we in a place where it makes sense to be more conservative or to be a little bit more aggressive? And that applies a little bit more of a tactical approach. But again, if our core is really solid like this, if we can take 50% of our portfolio and get this return just as much as if somebody else is 100%. And I've said that so many times now, but that's really a key, right? I can invest half as much. Think of it another way. Let's say there's a goal that you want to use your money for, and you decide that you're going to spend 25% of your money to put a down payment on your house, and you still can invest 50% of your funds in this, the original 50%, which is now 66%. Well, at least you're still getting a return that's very similar to what you would get if you put 100% into another one of these types of vehicles. And it won't always be like this. This core position works today in today's environment. And this is another key that I always want to hit on. There are going to be environments where certain funds work well and certain funds don't. Right now, and over the past 10 years, this fund has done a phenomenal job. And I don't see any reason to think that I won't continue to do a good job over the next couple of years. There will be a time where we will not be able to use this particular portfolio because of the long dated treasuries portion. As the treasury rate continues to drop, there will come a point where that won't be worth holding in it. But for now, it does make sense to hold, and we do want to continue to hold it because it still does provide some protection, some opportunity for capital gains in a decline. Like we saw in the early part of March, it held up really well for a couple days, for about a week and a half, and then the bonds didn't do so well, and that's where we saw the catch up, where it really did drop substantially. Not because the equities, although the equities were not doing well, it was mostly because of the bond portion of the portfolio. So to think that we have that 50% the core that's really driving everything, it does give us the ability to really use those satellite positions really effectively. We don't have to feel bad to have a satellite position not to give us much in the way of returns for a couple of years, because we know that there will be a time where some of those satellite positions work. Think of it like the all-weather portion. We could, in
That's right.
theory, do 50%. We could do we could get the core position here, and then add on top of that the all-weather portion if we chose to, half of the all-weather performance, and that's going to show us an even better outcome over this period of time.
Yeah.
So this is a sort of portfolio design that is really attractive and very, very helpful, and helps us when we communicate with people to say, well, how do you do it differently? Well, this is how we do it differently. We have a core satellite approach, and our core is big enough and strong enough. It's an engine that's powerful enough, to make it happen. I'm not perfect on cars here, but it's like a V8 versus a V4, right? I mean, we have double the amount of power. I don't know if a V8's twice as much as a straight 4 or not, because I know it's not a V4. It's different construction, the way they build the engine, but the point is like we have twice as much power here with the portfolio, and so we only have to make it half the size, and we can get just as much effectual influence on the portfolio.
Yeah.
So anything that you want to add to that, Daniel, as I was talking about the design a little bit?
Yeah. I mean, it's great that we have this core position. I mean, as you've said it enables us to capture, basically, the simple way of putting it is kind of what everyone else is doing. And that's not entirely true. There are a lot of people who change from that main strategy, but it's definitely one that's talked about a lot, or both of them are, the 60/40 and the core and the all-weather portfolio. Anytime you do any sort of investment research, that's kind of the initial approach that people use. But ours allows us to be very strategic in those satellite positions, whether that is, like you were saying, oil. Right now, oil and gas has taken a beating. Thankfully, we weren't holding those positions during all of that beating, but since then, it's something that we've been able to purchase and to have alongside these core positions. Also, some of those much more growth-oriented positions that we have with the large cap, and really focusing on those the big tech companies and just the really large cap companies that have done very well, and with reason, due to the 401k discussion we had on our last call. With reason, they've done well, and we think they'll continue to do well. So with those strategic satellite positions, we are really able to maximize that return even over the long term. And I love it because this 10-year, it doesn't fully reflect the type of portfolio that we're building here, but the core position, you can see how it still does well over this 10-year time. But with those other positions changing, excuse me, those diversifiers, those satellite positions changing at any amount of times in between, then based off of a strategic performance approach, we really are able to capture a really attractive return, I think. At least have been, and hopefully going forward are able to, but it's no
right, and
not reflected from the past.
Yeah, and to elaborate a little bit on the satellites that go around our core position, at one point they were international positions. At one point they were small cap funds. At one point there were value positions in there, or municipal bonds, depending upon portfolios or whatever it is. And each different environment, we have to look at that and say, like we talked about last time, does it make sense in the environment we're in today to be investing internationally when we think that dollar strengthening is going to be a major impairment to the performance of international securities? It's not a great time to be invested internationally, but also we don't want to consolidate everything into the United States and lack diversification. But that there is another discussion. We could talk about diversification. How do you achieve diversification with a portfolio like this? Well, our core position is diversified in itself. We can see that based on the performance of how it's a stabler ride, particularly in that 2011 to 2015 time period. We're not seeing as much bumps. I mean, it didn't go up as much, which is not great, but it's a flatter less jagged experience there for the portfolio.
Mm-hmm.
We can add in those pieces that give it some more jaggedness in a hope that we are getting some additional return.
Mm-hmm.
And that's really where we can add a lot of customization to a portfolio. Is you get a client that says they want to invest in one thing versus another, or they work in a field that they feel like they don't want any more exposure to because they get company stock or whatever.
Mm-hmm.
We have the ability to adjust what those satellite positions look like. And in the case of some people, they absolutely love a company, and all of the satellite positions end up in somewhat related to that company.
Mm-hmm.
That's a rare occurrence, but it does happen sometimes. And I think that's, we have the freedom a little bit to do that because we have such confidence that our core position can really be the engine,
Mm-hmm.
can really provide us with the portfolio that we're looking for. So
And
diversification. Oh, go ahead, and then we'll
um,
talk about.
like you were saying, I mean, I just want to go right back to it real quick. It's such a stable mover the entire way. I mean, you can see this line right here, this purple line, and just how it's so steady along the way, and that's what we're using this position for. It's an anchored build, is kind of what we're looking for. It's a position that's going to stay stable and stay more anchored, even as it's building. And of course, right here, when we had this double crash of stocks and then bonds, you know, when it's stocks and bonds, it still looks like everything else that's stocks and bonds. We had such a unique environment in March with that double crash that it really was
Yeah, that
it
was
was
brutal.
unique to walk through,
And
but
and I
it's
think it
stable all the way.
and I think it bears saying that we actually expect more of that kind of volatile activity from now on, right? I mean,
Yeah.
we kind of had a little bit of a golden era after 2008 where the markets weren't as volatile, and we've been building, as long as we don't have, big corrections and we don't experience more activity that curbs risk-taking behavior. It incentivizes more risk-taking behavior in the marketplace, and we're going to see more volatility over the next couple of years. So I do think that we're going to see a lot more volatility.
Mm-hmm.
We're going to do our best to control that, well, to take advantage of it, we really should say, but it's going to
Yeah.
be there, and we're going to have to live with it. But it does bring me to diversification. I think one concept that a lot of people have that comes to the fore when we talk about having 50% of a person's portfolio into one kind of investment, one kind of security like this is, well, what about diversification? Well, a couple things. First is that from an investment perspective, diversification is achieved when you invest in more than 40 stock positions, and usually across different sectors. But if you invest in more than 40 stock positions, then you have achieved diversification. Any
Mm-hmm.
additional stock addition from there doesn't really add much benefit to you from a diversification perspective. And this investment, the core that we use for the portfolio, actually is invested in 500 roughly different securities. So the core is diversified by itself. You could just buy the core and you have a diversified portfolio. Not to mention, it does have a bond portion attached to it as well. But all of the satellite positions are designed to give us additional diversification or additional upside. Maybe we're building those positions out like the oil and gas to give us some stability in the portfolio. I know you might think, how is oil and gas has really, really volatile? How is that stability? Well, it's stability if it's contraindicated to the things that are doing well, the things that also we're invested in. So if
Mm-hmm.
the things that we're invested in currently don't do well and they turn down, then oil and gas turns up. That's going to stabilize what the portfolio looks like, right? You do better to actually, from a portfolio construction standpoint, to have two volatile assets that are somewhat contraindicated is better. I say contraindicated. I'm not even sure if I'm using that word entirely correctly. What I mean is that when one moves one direction, the other one moves the other direction,
Yeah. Inversely correlated.
inversely correlated, they're going to stabilize. The effect is it's going to provide a very good diversifying effect to the portfolio. And that's what we're looking for, is do some of our satellites provide some of that stabilizing effect? And the truth is that when we look at the market from 1980 to 2010, we see a lot of ability for lots of different positions to provide that inverse correlation, to provide some protection and down moves and that kind of thing.
Mm-hmm.
And what we've seen over the past 10 years is an erosion of those positions that do that from doing that. We see that here in 2020, stocks and bonds, and pretty much everything that you would go to protect yourself, gold and the like, all of those really performed pretty poorly in that time. There may have been an immediate bump, but even the all-weather portfolio, which is the most designed to protect against an event like March, still went down. Least drawdown, granted, yes, it went down the least, but it still had a drawdown in that time period. It still went down.
Yeah, you can see it here.
With it. And you can see it went down the least because it starts at the lowest point and goes to the same point as the blue line. So, right, the 60-40 portfolio had a larger drawdown than the yellow one did. But again, which one would you rather be in? Well, to that point, well, to today, I guess on the year-to-date basis, or the one-year basis, I'd rather be in the all-weather because it's outperforming it. But generally, I'd like to have a little bit more upside than what the all-weather portfolio provides. So where I was going with that is that in the publicly traded investment market, and this is something that's unique about our perspective toward diversification, there's only so much diversification you can achieve when you're investing in portfolios that are all publicly traded. When a person can sell on a whim on a basis of recent market movement, that they're inclined to do that across their portfolio. And I often give people the mental exercise to say, let's say you have 10 different positions in your portfolio and 9 of them are down 10% or more, and you like them all equally. Which one are you going to sell? Well, you're going to sell the one most people are going to sell the one that's not down because they don't want to realize that loss. Well, what if your favorite investment is the one that's not down? And everybody looks at their portfolio, realizes they want to reduce risk, realize they want to raise some cash because they're just a little bit concerned about the market. What are they going to sell to do that? Most likely they're going to sell that great asset that has the best cash flow, that has the best price, that has the best management team, that has everything you could possibly look for in a wonderful investment. They're going to sell it. And what does that do? It drives the price down. So even though you have identified the perfect security, you're going to lose price in a crash because other people are going to drive that price down. It's not nothing to do with you or your own selling discipline or anything.
Or even that asset being bad.
Yeah, the asset can be the best
because
asset in the
it's
world.
the best. Yeah.
They're going to sell it because it hasn't gone down as much yet. And that's where you have to keep in mind that investor behavior, the psychology of investing really, really matters when it comes to this kind of thing. And that's why if you really want real diversification, you want an asset that's not going to go down much in a time like that. It really needs to be not in the stock market. For someone that has $1 million or more, they should seriously consider investing in real estate or in some kind of alternative investment, in a franchise, in a business, and something that's going to help them have a real diversification element. And I can't emphasize enough with the future ahead of us, with all the money that we've printed and everything else, that capital is relatively cheap and income is worth a lot. And so to the degree that you can find some investment that's going to give you income, that's going to provide you with cash flow, regardless of its price, right? Regardless of whether it's worth $1 million or worth 100,000, if it's paying you $900 a month or $1,200 a month, that's a great investment to have, regardless of how much capital it really costs you. So there will come a time. It used to be way back before the 80s that when people bought stocks, they bought them for their dividends. They bought them for their cash flow back to the investor because that's what they expected to receive. They wanted the cash flow. And they knew that a company just going up in price is all hunky-dory until it goes down in price, and then you lose it all. But if you can get cash flow from it, then there's a value associated with that, and they were buying it for the cash flow. And that started to change in the 80s when companies really started coming out that just didn't pay dividends, that would do share buybacks or other activities to return cash to shareholders that was not dividends. And it became a little bit more difficult for people to evaluate that. And these days we have lots of securities that don't pay dividends, and most people don't think of their investments as something that's going to pay them money. They think of their investments as something that's going to appreciate in price, and it will appreciate in price until it doesn't. And that's why a good source of diversification is finding some way to generate income. And newsflash, that used to be bonds, but bonds have dropped so substantially that the amount of capital required to get a stream of income from bonds is incredible, and it's just not worth doing. It's not a good investment. Thankfully, at the moment, real estate is still a pretty good investment to rent property or that kind of thing. But even there, that's a pretty high capital commitment, and there is a lot of risk in regard to taxes and and other issues that come up with owning a home and the requirements of effort and everything else involved. The reason that a lot of people do stock market investing is because it's relatively easy. You can do it passively almost entirely. You set your funds, you hire us, we take care of it for you. It's no problem. You can sleep at night, everything else. But at the end of the day, most investments that are going to give you true diversification require some effort. There are very few other kinds of businesses where it's so easy to invest, and so many people are investing that the crowd, quite literally, all of the other investors are going to collectively drive the market based on their behavior. And that could have nothing to do with your ability to pick stocks or your ability to understand the market or even build the best portfolios. They still have power in driving the market. You can see that here on this graph. In March, people panicked because the government changed the rules on a lot of things, told people they can't work, told the economy can't stay open. And what do you expect to have happen when you decide to shut the economy down for 2 weeks? You're gonna have impacts from that, and we see the impact of that in the stock market as well. So that's sort of the quick rundown on the portfolio. I did want to make sure I explain that, so that way, as we talk about portfolios in the future, you'll notice that in most of our conversations, we're not talking about the core position. The core position is the core position, right? We're talking about the satellite positions. What incremental changes do we make on the edges that are going to better protect and better provide for the kind of outcome that we want to have? And I would argue that this is the kind of investment management that that's really valuable. It's very simple to go out and buy a 60-40 mutual fund. It's very difficult to find a core position with the appropriate satellites that are going to be consistent and helpful throughout the time. And the other benefit to this is it scales very well. So somebody that has $100,000 or $1 million, some of the satellites might look a little bit different. The core pieces are going to be just about the same. And when you get up to those higher dollar figures, you do have the ability to really find some satellite investments that are really, really effective, that just aren't available to investors that don't have as much to invest. And that's not because it's our choice. This is a rule set down by the government. You could petition the government to change it. It's called the accredited investor rule and the qualified purchaser rule. So you can look those up and then email your senator and say, why are you restricting me from making investments that would help me in my portfolio? And I, for one, would be happy for that change. But it is what it is, and we have what we can deal with, and we look throughout all of what we have to deal with, and again, try to determine the best portfolios that we can.
Yeah. Yes, we do.
Yeah.
Do you want to take a minute and just talk about the income providing side of this core position? How it's kind of, not that we normally use it for that, but it is even available for that.
That is true. So the structure of our core position is unique and has some additional elements that people can use to generate some income. It's not really an income producing position. We like to think of it as a core, because it is a core, and we like to think of it as S&P 500 roughly, because that's basically what it invests in. The challenge is that that's not exactly how it works. It actually invests in long-dated treasury securities, a long-dated portfolio of bonds that is predominantly treasuries, some corporates, and all kinds of other things that the manager does to be able to manage the exposure and duration and everything associated with a long portfolio. And they have lots of experience doing it. We're very confident in their ability to manage that. On the equity side, instead of buying all of the stocks, right, they actually do buy all of the bonds for the most part, and some other derivative instruments that help them have exposure to the exposures that they want. On the stock side, they buy a swap. They enter into an agreement with a counterparty that says you will pay us the return of the underlying index over a certain period of time. So think of it like your index fund, your S&P 500 index fund. That's basically what the exposure that they're getting, but they're getting it through an agreement with a counterparty, which is often a bank or an investment bank or that kind of thing. And because it's being received through a counterparty as a result of a swap, all of that equity performance is received as income. It's received as a dividend payment over the terms of the swap agreement. So if the swap agreement is for 3 months or for 6 months or for a year, whenever that year is up or the 6 months is up, they get a payment. It goes one way or the other. Is the stock market down? then the fund needs to make a payment to the counterparty. Is the stock market up? The counterparty needs to make a payment to the fund. Whatever the performance is, somebody's making a payment of cash to the other party. And from a taxable perspective, when you receive when you receive a payment that's just cash from a third party without any underlying investment involved, that's income that's taxable to you like you earned it. And so this particular core position is unsuitable for non-retirement accounts. And I should have mentioned that before too. We take lots of attention to whether an account is taxable or non-taxable and determine which kinds of investments are appropriate for taxable versus non-taxable accounts, because we do not want to be in a situation where you're paying excess taxes because of the structure of the positions that we have in your portfolio.
Mm-hmm.
However, as a result of the fact that we are receiving not only the income from the bond portion of the portfolio coming in, which is giving us 2 or 3% of yield a year, we are also receiving whatever the equity portion is as a payment. So if you're in a position where you want to have income, you can receive a lot of income from this because all the equity performance is income.
Mm-hmm.
Now the downside to that is, if you did receive all of that as income, it's not a sustainable investment, right? You're going to receive so much as income, you're going to be eating away at the principal of the investment, right? The price of the investment is going to continue to decline over time, unless you're making so much on the investment that it actually can increase in price, even with the distributions as large as they are. And for example, it's not surprising in a good year where the market is up 10 or 12% for the distribution to be 10% or 11%. So to receive income distributions of 10 or 11% is pretty astronomical. But again, the reason you're receiving that, the reason you're receiving that income distribution is because they're paying you your equity performance each year as a dividend, as opposed to having it just accrue as a capital gain like you would in a traditional kind of investment. So yes, it does yield income. Yes, that can be favorable for a certain trusts that require you to pay out income depending upon how much income you receive. It can be phenomenal for those kinds of trusts. But for the most part, we reinvest those dividends. We don't want to receive the income, right? We want to be very careful with how we're managing that portion of the portfolio. We need to make sure that the core position is going to remain and not be paid out as income over time and forming a necessary amount of cash in a client's account.
So normally, if we're not automatically reinvesting those dividends, we periodically go and reinvest those and make sure that we don't build up too much of a cash position, but instead are invested.
That's right. And for certain accounts in particular, having that additional cash coming in and being able to redeploy them into the satellite positions or back into the core position can be a natural effect for rebalancing. And that's what we prefer to do. Notice we haven't really mentioned much about rebalancing. We kind of rebalance as the satellites need to adjust. And we will sell the core as the core grows. I mean, as you can see over the 10-year period, it's grown quite a bit. And so the core has grown in relation to other satellite positions to be more of a percentage of the portfolio than what we like to maintain. So we will sell the core on occasion, but for the most part, our satellites are designed to really give us a lot of the excess performance. So that should work.
Hey Dan, sorry, could you pause the recording for a moment?
Sure.
Thanks.
So we're back. Just to summarize here, we use the core position in the portfolio to really be the engine. I've said that so many times, but it's true. And what it allows us to do is to build out the satellite positions in any direction, in any which way we want. So for younger, aggressive clients, that could be more exposure to large cap momentum growth names, and for more conservative clients, it can be more of the all-weather type of positions in a portfolio that are going to protect it in the event of a more concerning market decline. So that's how we attempt to build the portfolios. As we continue to come across new and interesting investments or investments that meet the bar of due diligence, as well as provide some exposure to a portion of the market that we're looking for, we're going to do that. We're hopeful that more alternatives for core positions will come out, as the core position that we have here that we're demonstrating is really effective for retirement accounts. We don't really have a similar core position for non-retirement accounts. And that's just the nature of, again, the taxable impacts of this particular core position. but they're coming out with all kinds of great investments all the time. And I think one of the reasons that this particular core position is available to us and has such a long track record and isn't duplicated everywhere across the industry is because it is really effective almost only in retirement accounts. And I think secondly, there will be a time that it won't work. And so we will have to change it at some point, but we don't think that that's anytime soon. We hope it's not anytime soon because we like having this kind of exposure and this sort of portfolio construction for you and for our clients. So if you have any questions about this as anything, please don't hesitate to reach out to us and to ask for specifics in regard to your account or to what an account would look like. We'd be glad to have that conversation with you. So thank you for your time today, and maybe say a prayer for September 11.
Thank you.
All right, we're all done.